Welcome to Sheen Research, your strategic partner in comprehensive investment analysis.
Today we're digging into Spotify's Q3 2025 results. And for you, our mission is really to get past the headlines and understand the strategy. Because on the surface, Spotify delivered a quarter of, well, just massive scale.
Oh, absolutely. The headline figures were fireworks. I mean, not only did they blow past that 700 million monthly active user milestone,
Oh, you passed it.
reaching 713 million, but they posted an operating income of 582 million. That operational strength, plus this claim of shipping over 30 new features, it really positions Q3 as the high point of their year of accelerated execution.
It was a monster quarter on the surface. But this is the key thing. The financial picture requires some careful filtering. We have to distinguish between real operational profitability and let's call them accounting windfalls.
And that's where the real insight is hiding, right?
Right, exactly. The big strategic takeaway here is that management is aggressively repositioning its costs. They're trying to prioritize becoming this multi-format powerhouse, even if it means using their profitable premium segment to sort of clean up the margins in the ad business.
Okay, that sets up our narrative perfectly. So let's start with that user funnel, because scale is what Spotify is all about. The MAU numbers, they just smashed guidance.
They absolutely did. Total monthly active users hit 713 million. That's an 11% year-over-year increase, and it beat the top end of their own guidance by 3 million users.
And that wasn't just in one region, was it?
No, this was broad-based growth. We saw strength across all regions, but it was really led by rest of world, Europe, and even North America.
So if the total user growth was that stellar, what about the conversion to paying users, the premium subscribers? That felt a little more tempered, maybe.
That's a good way to put it. Yeah. Premium subscribers reached 281 million. It's a solid 12% year-over-year increase, but it was right in line with what they had guided for. No big surprise there.
And where did that growth come from?
Mostly Latin America and North America, which shows that their global strategy is definitely working to drive people to pay. And just to round it out, the ad-supported free users, they grew 11% to 446 million. So the whole flywheel is just spinning really fast.
Okay, but here's the interesting paradox. When you look at the economics, average revenue per user, ARPU, in that big premium segment, it actually fell year over year. That seems completely counterintuitive after all those price hikes they pushed through.
It does, and this is a classic case of where you have to look under the hood. The reported premium ARPU was around 4.53, which is a 4% decline. But here's the thing.
Okay.
The entire reported decline was about 0.1. And that was almost exactly offset by unfavorable foreign exchange rates.
So you're saying FX movements completely wiped out any benefit from raising prices?
They did. And not just that, the price increases also had to fight against other headwinds. See, they're expanding in these lower-priced emerging markets, which creates a mix shift that naturally pulls ARPU down. That mix shift decreased ARPU by about 0.14, but the price increases they implemented boosted ARPU by that exact same amount, 0.11.
Wow, that's a fascinating balance. So if you strip out the currency noise, the real story is that their pricing power is strong enough to perfectly cancel out the dilution from expanding into cheaper markets.
Precisely. On a constant currency basis, premium ARPU was flat year over year, and that proves the strategy. They can raise prices enough to stabilize ARPU while still growing paid subscribers by 12%. And that volume is what pushed premium revenue up.
And I'm guessing that currency shadow affected the total revenue picture too.
Oh, absolutely. Total revenue for the quarter was $4.27 billion, up 7% year over year. But again, adjust for the strong euro, and constant currency growth was a much healthier 12%. That's a 450 basis point headwind from FX.
Okay, let's pivot to profitability, because this is where the numbers just got almost mind-boggling. Operating income blew past guidance.
The reported results were spectacular. Operating income reached $582 million. That's a huge 28% jump from last year, a 13.6% margin, and it crushed their guidance of $485 million.
But the net income figure, that was even more striking. It was $899 million. That's nearly triple last year's number. Basic EPS at 4.36. Wait a second. If operating income was $582 million, how did net income end up almost $900 million?
That is the critical question. And the answer is that a huge chunk of that outperformance was driven by, well, non-operational benefits, accounting. First, the operating income got a little boost because social charges...
It's the payroll tax tied to stock options, right?
Exactly. Those came in $41 million below what they had forecasted just because of how the stock price moved during the quarter. So that's a non-cash, non-operational kicker right there.
Okay, that explains some of the beat on operating income. But to get from $582 million in profit to nearly $900 million in net income. There must have been a massive tax benefit in there somewhere.
You nailed it. The income tax line actually showed a benefit of $72 million. It gave them a negative 8.7% effective tax rate. And this was driven primarily by a single item, a $202 million benefit.
A $202 million benefit. From what?
It's related to something called Section 174 R&D costs. Basically, tax law changed how companies deduct R&D expenses. This benefit is from an accelerated deduction of R&D costs that they had previously capitalized.
Okay, so just to frame that, is this a sustainable benefit, or was this a massive one-time accounting windfall that just inflated this one quarter?
It is a huge one-time accounting windfall. It's a non-cash benefit that dramatically lowered their tax bill for this quarter, and it's responsible for about 2/3 of that massive net income number. It's great for them, but it is not indicative of their core operational profitability.
That is absolutely essential context. So let's move on to gross margins, because this is where you can really see those strategic cost shifts you mentioned at the top.
You really can. Consolidated gross margin expanded to 31.6%, which is great. But the segment margins tell a much more complex story. The strategy of using premium as a cost sink is so clear here.
How so?
Well, premium revenue is 90% of the total business, right? It hit $3.8 billion, but the gross margin in that segment actually went down a bit year over year to 33%.
So why the pressure on their cash cow?
Strategic investments. The margin compression came from higher costs for two big initiatives: the new Spotify Partner Program, or SPP, and crucially, higher audiobook licensing costs. They are piling content costs for video and audiobooks onto the premium P&L to make that subscription more valuable.
So the premium user is getting more for their money, but the cost of that extra value is eating into the premium margin. Now, let's go to the ad-supported side, because it's the complete opposite story. Revenue went down, but margins exploded. How?
Yeah, ad-supported revenue struggled. It was down 6% year over year to $446 million, and basically flat if you adjust for currency. And yet, the gross margin jumped from 13% last year all the way to 18.4% this year.
That is a remarkable jump for a segment with shrinking revenue. What happened?
It was largely artificial. Or you could say strategic. The core driver was a $24 million reduction in podcast costs. And that came from that critical shift we're talking about. Video podcast content costs were reallocated away from the ad-supported segment and moved over to the premium segment through that Spotify Partner Program.
Ah, okay. So management basically cleaned up the ad-supported income statement by shifting some of its costs over to the much bigger premium segment.
That's exactly what they did. It makes the ad-supported margin look much healthier and buys them time while they transition to higher margin automated ad sales.
Speaking of efficiency, let's look at operating expenses. They're talking about this year of accelerated execution, 30 new features. Yet total OpEx actually declined 2% year over year. R&D expenses were down 10%. How do you execute faster while cutting R&D?
That's a sharp point. And again, it comes back to those non-cash social costs. R&D spending didn't fall because they fired developers. It fell because of a $46 million decrease in those social costs tied to the stock price. The underlying discipline is still there.
So they are still investing.
Oh, yeah. Sales and marketing was up 5%, driven by a $22 million increase in advertising for campaigns. They're still spending to get new users in the door, and they're doing it all while staying incredibly lean, ending the quarter with just over 7,300 employees globally.
That focus on efficiency is what enables those product launches. So let's talk about those strategic moves. Of the 30-plus features, what really moved the needle for them?
Well, the speed of iteration is remarkable. They rolled out lossless audio to over 50 markets, which is a big deal for audiophiles. But the real focus is on social sticky features.
Like the in-app messaging.
Exactly. It's proving to be incredibly successful. They said nearly 25 million users have sent almost 200 million messages since it launched. That's a powerful engagement loop.
And that social loop is critical to their core philosophy, right? The more you play, the more you pay. It drives engagement, which helps defend those price increases we talked about.
It absolutely does. And they're pushing hard on AI. Their partnership with ChatGPT to create recommendations is what they're calling Personalization 2.0. It's about using generative AI to understand taste and context on a whole new level.
And their ubiquity strategy seems to be winning over advertisers. They signed new DSP partnerships with Amazon and Yahoo.
And that is the key to fixing the ad business long term. Since they launched their own ad exchange back in April, advertiser participation has grown by a massive 142%. Shifting to programmatic is crucial for lifting that struggling ad revenue.
We also saw major news on the content front, with video and the big label relationships.
Yeah, time spent with video content more than doubled year over year. They have almost 500,000 video podcasts now, and the deal to license 16 of them to Netflix is interesting.
What's the strategy there?
Management frames it as a creator-first move. Give creators maximum reach, which ultimately drives more usage back to Spotify. It's a distribution play.
And finalizing those new multi-year licensing deals with all the major music labels seems foundational for everything else.
It is. The critical piece they secured was broader video rights. That's what unlocks the product innovation they need. It gives them long-term flexibility on costs as they move deeper into video and other formats.
It's what lets them deliver features like lossless audio without blowing up their cost structure. And speaking of pricing, management was very clear that retention rates held up even after all those price hikes.
They are very confident in what they call the value-to-price ratio. They believe all this feature development is successfully raising the perceived value, which defends the higher prices and fights that ARPU dilution.
Okay, let's wrap up with the balance sheet and what they're guiding for in Q4. How healthy is the cash position behind all this?
The balance sheet is a fortress. Free cash flow hit a Q3 record of $806 million. Over the last 12 months, it's $2.9 billion, and they're sitting on $9.1 billion in total liquidity.
And they're putting it to work.
They are.
Yeah.
They bought back $77 million in shares this quarter, bringing the year-to-date total up to $410 million. They're actively returning capital.
Looking ahead, their Q4 guidance shows a lot of confidence in user growth continuing.
It does. They're forecasting 745 million total MAUs, which implies another 32 million net adds. For premium subs, they're guiding to 289 million, or 8 million net adds. They did caution that's a bit below last year's number, mainly due to expected churn from the price increases.
Which is to be expected, and on the financial side.
They're projecting total revenue of $4.5 billion, which implies a really strong 13% year-over-year growth on a constant currency basis, and they expect profitability to continue.
What's the guidance there?
Gross margin is projected at 32.9% for Q4, and operating income is expected to reach $620 million. They did give one little warning for the future, though.
What was that?
That Q1 2026 gross margin will likely step down from Q4, just due to the normal seasonal weakness in advertising after the holidays.
And that brings us right back to the ad-supported segment, which is really the core strategic challenge here. Management sounds optimistic, but that business was flat in Q3 and is clearly still in transition.
It's the elephant in the room. Despite all the progress they're making with programmatic ads, management was very explicit. They said they only expect the ad-supported growth rate to really improve in the second half of 2026.
The second half of 2026. That's a long turnaround.
It is. It's a very lengthy timeline for a business they're investing so much in to transform.
So what does this all mean for you? The story is a complex mix. You have this tremendous user scale and pricing power that are successfully fighting macro headwinds. The bottom line performance looks stellar, but we know now it was significantly inflated by that large one-off tax benefit. And crucially, this cost-shifting strategy shows management is willing to trade short-term premium margin for long-term dominance across music, podcasts, and audiobooks.
They're banking on engagement and just being everywhere to justify all this investment.
Which raises the central challenge and the final thought for you to consider. Given this commitment to maximizing engagement and expanding into all these complex content verticals, how quickly does that advertising business actually have to deliver on its promised turnaround in the back half of 2026? If that timeline slips, the premium segment will be forced to carry the full weight of subsidizing three complex businesses for even longer. That's the leverage point to watch.
That is the essential trade-off in the long-term investment case.
With that, we conclude our coverage for this video. Thanks for joining us. Sheen Research. Mindful Markets. Measurable Meaning.